Welcome back. Retail sales did surprise to the upside this morning, up a tenth versus street expectations of a decline. You can see we had a big gain the prior month. We built on that. Our next guest is looking for some positive surprises in the sector, digging deep into earnings to find some lesser-known names he says are at key inflection points ahead of the holiday season. One of them is already up 62% in the past year. He thinks that run continues. Joining us now is Carden. He's an analyst at William Blair. Dylan, it's great to have you here. Welcome.
Yeah, Kelly, thanks for having me.
What is the key inflection point you think some of these names are facing?
So the second quarter was interesting in that a handful of our names really did see a material inflection in key metrics, primarily comp as it relates to retail. And a lot of that has to do with some names that saw a much better 2020-21 period that then had to lap that performance in the subsequent 2 years, right? So you're kind of coming out of the wilderness for a lot of retailers like Boot Barn or Chewy, which we're calling out in this report. And then for others, it's just been a longer journey of recovery. Torrid is a name that we upgraded today. They have new management that's been in place since early 2022, and they've just taken some hard licks as it relates to cleaning up some of their inventory management and marketing systems. So it's really, I think we're just broadly in a period of more idiosyncratic performance where there's some opportunity to kind of actually do some real stock selection. And as it relates to inflection points and why those matter, I would echo some of the comments of your other guests. I do think that defense makes more sense in this market versus necessarily offense. And inflection can be a really defensive play in that you consider that you're comping more against yourself rather than the broader market. And I think we are in a situation here going into the back half where I wouldn't use the term weak, but if you look at the fact that the consumer has spent through savings coming into this year, inflation is moderating but still growing on big numbers, and the fact that you're seeing a lot of, particularly apparel retailers, increase or at least normalize their inventory levels, I think you're looking at a relatively soft holiday period where I'd rather be in defense and inflection names.
So I think what makes people a little nervous is that these are also fashiony and trendy, and it's sometimes hard to be confident in that, other than kind of following TikTok and trying to see what all the influencers are doing. Of the names that you've rattled off here, Chewy, Boot Barn, Torrid, for instance, even Zumiez, Warby, designer brands, Duluth, Boot Barn is really the only one that's positive on a 3-year basis. It's up 73% in that time period. Should that make me, if I'm a defensive sort of minded retail analyst, should I just stick with that winner and maybe stay away from some of the others, or would you see it as almost the opposite?
Well, we do get the pushback all the time on Boot Barn that we missed it, right? I mean, This happens anytime Boot Barn's up any meaningful amount in any short period of time. The narrative is always, that was a trade that is missed. I mean, I think Boot Barn, of what you're talking about, right, of fashion risk, Boot Barn actually stands aside in that really 70+% of its business is workwear, right? 80-some% of what they sell is on auto replenish, where they sell it and they immediately order another one, right? So whereas the narrative on that one particularly got a little bit overextended, I think, on that it was a Yellowstone or a Taylor Swift kind of trade, the reality is that it is largely de-risked from a fashion standpoint. And what always saves the stock, and why I think you never really saw it collapse like you did at Chewy, is that they have capacity to double their store count here in the next 8 years, right? They've got a growing margin profile as they do that, right? So you're looking at 20+% earnings growth over the next 3 to 5 years for a stock that trades in the low 20 PE range with a growing free cash flow yield of 5%. So all of that, I think, is still relatively dynamic as it relates to, continuing to own shares. Yeah. I think, as, the question on do you sort of not buy others as a result of that continued success, my view is that you kind of make money in the shadows where people are more cautious, right? I mean, Chewy has been one that people are just chronically net negative on. Torrid is another one where people are looking at it as a fashion risk play. No one's been able to figure out the plus size market, it seems, for a long period of time. So I think if you're more inclined to take on a little risk and buy into those inflection stories now, there's potentially more reward there.
Yeah, it's really interesting. Yeah, and on Torrid, you just upgraded out to outperform, seeing kind of a nice comp print in the second quarter. That could be an inflection point. On Chewy, you're saying active customers grew sequentially for the first time in a year. Torrid, you say, maybe this is a little bit more baked in. The valuation's higher as it appears to be in recovery. Warby Parker is one where you see an inflection point in gross margins, and a name we haven't talked about in quite some time.
Yeah, it all depends on what the metric that you're looking at that's inflecting. For me, Warby hasn't really had a growth problem per se. Its growth has been in and around kind of the low double-digit range here for the past several years as they've been growing stores. That's predominantly driven the growth. The real question for me is what Warby Parker is doing is they're trying to be a more holistic optical retail business. And that really is just code for moving more into exams, progressive lenses, contacts, right? And as you sort of mix shift into some of these other categories, namely exams and contacts, those have a relatively significant drag on margin relative to something like a progressive lens, right? And so their gross margins for the past couple of years have been in steady decline as they've been kind of shifting into some of these newer categories. Seeing gross margin stabilize with still pushing into some of these newer categories is encouraging because you can start sort of underwriting a floor on where margins might net out, right? And if this is a company that can indeed keep gross margins in the mid 50% level while continuing to sort of grow scale on a bigger business, you're looking at 100, 150 basis points of margin expansion per year on an op margin standpoint, which could be relatively compelling, early days of margins still being relatively low.
And just quickly,
what, retail should do.
Sure, we showed design.